Welcome to Vskills YouTube channel. Today, you will learn about the top interview questions for Wealth Manager. So, let's get started. Question number 1. As a wealth manager, what will be your action if the client wants to do something ill-advised? The answer is, as a wealth manager, I will make the client aware of the possible consequences by expressing my opinion and will ensure that the client has discussed this with their family, dependents, etc. Further, if the client is insistent, then take requisite sign-offs and have an exit strategy to minimize the losses. Question number 2. What is the essential quality that a wealth manager should have? The answer is, the main quality a successful wealth manager should have is, the ability to maximize returns as per the risk profile of the client and also protect the capital. As the main function of wealth manager is, wealth maximization but also protect the capital, this is the quality that every wealth manager should have. Question number 3. What functions are performed by a wealth manager? The answer is, a wealth manager performs a multitude of functions, which usually includes development of client-centric investment portfolio, identify opportunities as per the investment plan for clients, manage asset portfolios, developing and implementing client investment strategy, supporting financial advisors and developing and maintaining customized asset allocation strategies for clients. Question number 4. Are there any prerequisites to be a wealth manager? The answer is, yes, there are prerequisites to be a wealth manager. As for the wealth manager goes without saying, that should have good knowledge finance, banking and mathematics as well as must be ethical, trustworthy for managing vast amounts of money. Question number 5. List the roles in wealth management. The answer is, wealth management is a wide domain and has multiple roles on offer which primarily either are front-end which markets products or deals with customer and back-end which actually manages the wealth. The front-end usually includes client, the role of acquisition manager who finds new clients and is also called as sales role, and the business development role for managing relationship with clients for upsell or cross-sell. Question number 6. What will be the future value of 10,000 rupees in 5 years from now, at an interest rate of 8%? The answer is, the future value, also called as FV, is the value of an asset at a specified future date while assuming other factors to be constant and also assumes a constant rate of growth. The formula used is FV equals PV, 1 plus R, and hence, the future value of 10,000 rupees in 5 years at an interest rate of 8% is 14,693.28. Question number 7. Will an increase in EPS is anyhow linked with increase in net income? The answer is, no, an increase in EPS does not link with increase in net income. Question number 8. List the factors influencing the performance of a wealth manager. The answer is, there are many factors which affect the performance of a wealth manager, as access to data is needed by the wealth manager to take a quick call on the investment regarding its safety and growth. The major factors influencing the performance of a wealth manager are 1. Market know-how. 2. Obtaining timely and accurate information for a financial entity or product. Question number 9. Describe risk tolerance. The answer is, risk tolerance is an essential aspect of wealth management for a client and wealth manager considers it as critical. It affects the financial product to invest in. This refers to the investor's tolerance for volatility or suffering a loss. Question number 10. Explain risk capacity. The answer is, risk capacity influences the investment options available to the wealth manager for a client's portfolio. This refers to the level of financial capacity a client can withstand market loss. Question number 11. Illustrate longevity risk. The answer is, longevity risk is a type of risk being faced by clients which has to be addressed by the wealth manager while managing their wealth. This is faced when the client has excess capital as there is increase in life expectancy of the pensioner, thus needing a higher payout. Question number 12. List some investment risk management strategies available to a wealth manager. The answer is, a wealth manager needs to address and manage risks in an investment so that the investment is safe and is available in time of need. The safety is dependent upon the risk management strategies applied by the wealth manager and the financial product type. Risk management strategies usually applied are hedging, diversification and insurance. Question number 13. How do you manage the client's data related to wealth management? The answer is, client's data has the utmost priority for securing it as it is sensitive in nature and financial or personal details as if the client needs strict data security and data privacy measures. We use reliable service with role-based access to data so that data access is provided to employees as per the role of the employee. There are data monitors who constantly monitor and audit data changes and authorizations. We conform to Europe's GDPR and other data security and privacy standards. Question number 14. What has been your experience with automation in wealth management? The answer is, automation has emerged as the new technology which has revolutionized wealth management. I have used RPA, that is, robotic process automation, to automate many redundant processes and made my staff more productive and quick to respond. Question number 15. What are the current wealth management products you dealt with? The answer is, I am having experience with various wealth management products which included mutual funds with access to more than 300 plus mutual fund schemes from 21 AMCs, portfolio management services, PMS, alternate investment funds, AIF, real estate funds, unit-linked products, ULIPs, insurance product, keyman insurance and property loans. Question number 16. What do you think about the most important role of a wealth manager? The answer is, as a wealth manager, my focus is to provide the wealth management services needed by client at any stage of their financial goal journey so as to fulfill the customer requirement for maximum returns along with security and risk management. Adopting technologies which are more efficient and effective for the organization. Reducing costs with maximum returns without losing on security or risk management is the primary motto. Question number 17. Where do you see yourself in the next 5 years of wealth management? The answer is, I foresee a bright future as I will gain more skills and knowledge in the domain of wealth management by using new technologies and fulfilling the needs of more clients, as needed by my organization. Question number 18. What is the impact of wealth management on the goals of an individual? The answer is, wealth management has a high impact on an individual as the impact is both short-term and long-term. Wealth manager maximizes returns for the client on a continual basis, hence, client gets short-term benefits if investing in equity or short-term investments. The long-term impact is addition of efficiency and the compounding effect on the investment which develops a corpus for needs to be addressed later in life like retirement, child marriage, etc. Question number 19. Calculate the value of a debenture which yields 9% per annum, payable semi-annually and will mature in 1 year at 1 lakh rupees? The answer is, the present and future value formula is used. The value of a debenture is Rs 101,119.41. Question number 20. How do you maintain discipline in your wealth management team? The answer is, maintaining discipline in the wealth management team or any team is an important aspect for a productive environment in the team. I maintain discipline by making every team member aware of the applicable HR rules and regulatory laws for it. Any disciplinary action if needed, are taken in private so that the employee can correct himself, which will dissuade any hostile work environment development. Question number 21. How do you assign goals to your wealth management team? The answer is, I assign goals to my wealth management team on an ongoing basis and involve analyzing multiple factors like skill level, availability, etc. Before that, assignment goals are also finalized as per the SMART approach for goals definition and development. Question number 22. A company has EPS of 20 rupees with share price as Rs 600 per share. Compute the P/E ratio for the company? The answer is, the P/E ratio for the company is 30. Question number 23. How do you keep yourself updated of new trends in wealth management technologies and products? The answer is, many new financial products are launched, like we see emergence of AIF, REIT, etc., as well as technologies to automate like RPA, AI, etc. I keep myself updated by attending industry seminars and conferences by market leaders as available online or offline. Question number 24. What is your greatest work-related accomplishment in wealth management? The answer is, my greatest work-related accomplishment in wealth management has been the automation of a client weekly report on their portfolio by using RPA within the time and also budget constraints. Question number 25. Explain regression. The answer is, the characteristic regression line, CRL, is a graphic representation of the market model. The characteristic line is used to measure statistically the undiversifiable risk and diversifiable risk of individual assets and portfolios. The characteristic regression line of an asset explains the asset's systematic variability of returns in terms of market forces that affect all assets simultaneously. The portion of total risk not explained by characteristic line is called unsystematic risk. Question number 26. What do you mean by modern portfolio theory? The answer is, modern portfolio theory, MPT, is a theory of finance that attempts to maximize portfolio expected return for a given amount of portfolio risk, or equivalently minimize risk for a given level of expected return, by carefully choosing the proportions of various assets. Although MPT is widely used in practice in the financial industry and several of its creators won a Nobel Memorial Prize for the theory, in recent years the basic assumptions of MPT have been widely challenged by fields such as behavioral economics. Question number 27. What is efficient market hypothesis? The answer is, according to the EMH, stocks always trade at their fair value on stock exchanges, making it impossible for investors to either purchase undervalued stocks or sell stocks for inflated prices. As such, it should be impossible to outperform the overall market through expert stock selection or market timing, and that the only way an investor can possibly obtain higher returns is by purchasing riskier investments. Question number 28. Explain compounding. The answer is, the process of investing money as well as reinvesting the interest thereon is called compounding. The future value or compounded value of an investment after n years, when interest rate is R%, is given by FV equals PV, 1 plus R, N, where FV equals future value, PV equals present value that is, given, R equals percent rate of interest, and N equals time gap after which FV to be ascertained. Question number 29. Did you ever fail to achieve goals as wealth manager? The answer is, yes, there was an instance when I failed to achieve the defined goals as wealth manager. I had planned for adding a new technology to automating a client's form submission for a fund and for which requisite equipments procured and training imparted. But, due to COVID-19 pandemic, lockdown was enforced which stalled the planned rollout. After lockdown was lifted, we implemented the automation and achieved quicker and accurate submission of clients' forms. Question number 30. Explain weighted mean. The answer is, weighted mean, is frequently seen in portfolio problems in which various asset classes are weighted within the portfolio. For example, if stocks comprise 60% of a portfolio, then 0.6 is the weight. A weighted mean is computed by multiplying the mean of each weight by the weight, and then summing the products. For more such videos, subscribe to our channel.